Hello, my name is Maurice Washington. I want to welcome everybody to another episode of Executive Talk. Those who are watching live and those who are listening later on our podcast, thank you so much for being here. In today's segment, we're going to talk about the 2024 state of insurance. As you know, we've all gone through a lot of changes, and it's very important for us to keep an eye on the trends and things that are happening around us and the cause and effect of insurance. So with me today to actually talk about it a little bit deeper is we have Rick Callaway, which is our business insurance specialist. And we also have Matt Harvey, which is our head of brokering. So gentlemen, welcome to the stage. How are you doing today?
Doing just great. Looking forward to a great show and all of Matt's wisdom.
Thank you very
Matt,
much.
are you ready to give us some wisdom?
I hope so. Hopefully some insight, maybe not wisdom.
That's it. So let's go ahead and jump right into it because again, to me, I feel like it's very serious. And if I was to put a time frame on it, I want to be able to take us back to COVID up into now, which is about 4 years. I think that's about 4-year time span. We've all gone through a lot of changes. We've seen a lot of events, but it's very hard to really keep an eye on where insurance has been. I know we've seen a lot of rate increases on everything, on our food prices, on gas and housing and so on and so forth. But it's very hard to speculate on how insurance is responding to all these changes. So that's why it's important for the two of you to really help us out. And let's go ahead and talk about, first thing and foremost, let's talk about the global trends that everybody is seeing. Matt, what kind of global trends is having the market respond the way that it is?
Well, generally what we've been seeing since the end of 2023, and I'm talking really here in London, we touch global business, so we touch business from all parts of the world, is that we have seen certainly less pronounced rate increases. We've seen that insurers' results, what they call the measurement that they use in order to define their overall profitability, called a combined ratio. We found that those have been holding up pretty well, and in almost all cases, the large Euro Res, the global Res, have been having combined ratios in the late 80s or the early 90s, which is a fantastic place for them to be. What we have also seen is that generally the property and casualty book globally has been profitable, and insurers have been looking at expanding upon their current positions on where they're participating on programs and seeking to write more or hold their positions. We've also seen some very aggressive moves by certain insurers in certain territories on certain lines of business, where they've been looking to come in and grab some market share. What this means, though, for the ultimate client at the moment globally is that we're not going to be seeing major rate reductions, but certainly on the complex business, which is what we tend to see, we would be looking at flat to low single-digit increases on clean business that is without significant new critical natural catastrophe exposure in, obviously with some exceptions, which we'll talk about a little bit later on. On the casualty side, that is still very divided between the United States and the rest of the world. With the United States, there is, because of the legal system, legal practices, and also the pay-to-play legal scenarios where people are financed in cases against insurers, there is a very different set of appetites that there are for non-US buyers. And in addition to that, buying patterns outside of the US are different. In the major economies, in the UK, Australia, Canada, the European Union, Japan, you do tend to have higher levels of purchase. Outside of that, you tend to have lower limits. So it's a lot of the business from, say, mainland Asia, the Middle East doesn't generally see its way through to us unless it's something a little bit unusual or niche, such as critical automotive components or fireworks, those kind of things. So we're generally seeing again that it's far less pronounced globally, the rate increases. On the financial lines, certainly there has been a softening as well. D&O has come off of its heightened issues that we saw a number of years ago. where it was very difficult and very expensive for clients to purchase D&O insurance. And in cyber, we're delighted to say that London is open for business. And we are really seeing now that there are a lot of cyber insurers who believe that they have some excellent products which don't just focus around paying out checks in the event of a ransomware or a breach event. It's actually about providing services to prevent these events from happening and then immediate care following an event happening. So it's almost like it's not just insurance, it's also a service arrangement with a reputable partner that now London Market is certainly offering. And we've seen some growth in some real interesting emerging economies and a willingness for insurers to work with us.
Okay.
A few other things just on the global trends.
Sure.
Due to the instability in the world, we are seeing heightened demand for political violence and terrorism cover. We're seeing as well, we're in 2024, we're in a major year of election cycles. Outside of the United States, there are elections in the United Kingdom, throughout Europe, and also the largest democratic exercise in the world is going to be happening in India. So there is now more demand placed for PVT and SRCC insurances, and there is capacity out there. If any one of people listening to this do have demands outside or needs outside of the US, there is capacity that's available. We have to structure placements in a certain way in order to get the best deals for clients. Russia is also still a major issue for us, and we as Acrisure do not touch anything that has got a Russian touch point at all, and that is pretty much the same for the whole of the market at the moment. Insurers will not do that. Fossil fuels, coal, oil sands is also becoming a diminishing appetite for a number of insurers. There are certainly exceptions to that, and the MGA offering is becoming stronger and stronger as niche markets out there that are dealing with coal mining, both for power stations and for metals manufacture, but also some of the offshore exploration projects for new oil fields or expansions of existing oil fields are difficult to get the coverage that clients really want, and that is very much a global trend as well. And globally as well, we are now seeing insurers also, just flipping back to the property, the builder's risk, and also the energy and power lines, secondary natural catastrophe events are certainly under the spotlight. So an example of that would be South African and Australian bushfire. They're actually being rated in certain cases now, and we're also seeing certain deductibles being added as well, which are heightened in the event that these losses occur.
I'm curious, Matt. You brought up the word instability, which obviously is just like a huge noise to the insurance industry. It breeds risk. So one of the things that I see constantly and that we're constantly talking about in the news cycle is the wars that are happening in other countries, and just kind of, just between countries, and just are these wars creating this instability across the world globally?
Absolutely. The conflicts in Ukraine and now also between Hamas and Israel are causing instability. They have a knock-on effect of causing geopolitical issues, geopolitical protests, geopolitical trade restrictions. And I think it's also fair to say that we are also going to see some instability probably coming up soon in the Taiwanese Straits as well, and with China and Taiwan. So yes, is the short answer. We also have knock-on events from this, such as the Houthis in the Yemen were attacking Western shipping. So they were looking at disrupting shipping lines in the Red Sea and going down into the Suez Canal. So that does affect one of the world's busiest shipping lines. Absolutely.
Are we seeing more piracy?
Yeah.
What was that, Rick?
Are we seeing more piracy now?
Oh, yeah.
We are seeing more piracy, and we are also seeing more war events from the pirates as well. A lot of these groups are there that they will pay to play. So it doesn't really bother them if they go and hijack a ship and take the goods, or they launch rockets at it. They're there to do whatever their paymasters tell them to do.
Wonderful.
Wow. Well, let's go ahead and get into the U.S. market, because that was a good scope as to where we are globally. But the U.S. market, you're talking about some of the property and casualty and other lines. Go ahead and take us down the pathway as why those are important and how those are shifting, or I guess ultimately the instability that you may be seeing show up in the U.S. market.
Sure, I'll take this from one angle, and Rick, please feel free to come in and as you're breaking on the ground. But we could say what we've certainly seen over the last few years. And what happened after Hurricane Ian was that reinsurers accrued a number of quite significant losses, and that resulted in the cuts in treaty, both in terms of capacity and attachment points. So insurers were taking higher net retentions. And there was also a number of elements of confusion a couple of renewals ago with treaties, where there was a lot of differential terms on programs as the treaty market went into what I would call a true hard market for the first time in probably over a decade. What we have been seeing now is, though, that the treaty reinsurance terms have certainly settled down, and also carriers have, the primary carriers have been a lot more profitable across their lines. However, there has been some issues that occurred during 2023. Inflation is still a big issue, and the replacement cost of buildings is a big issue. And ensuring that there is an effective as well and an accurate replacement cost value that is put in means that insurers have been seeing differentials between what they believe losses would be and what they actually are. That's why we're seeing a lot more average clauses. We also had the Maui wildfires, which was devastating and created losses to businesses and also to high net worth individuals, as well as ordinary people living on the island of Maui. There was also convective storms in the Midwest, which were also devastating and very, very costly. There was also the floods as well, which spread from the Mideast over to Las Vegas last year, which was very surprising, unpredictable, and costly as well. However, what we are seeing is that there is quite a lot of capacity available in the US domestic market for property and casualty. There are some difficulties within that, and Rick and I were talking about this beforehand, particularly around frame. So Rick, sorry if you want to jump in.
Yeah, the capacity may be there, but the insurers are being so picky. Unfortunately, they're not writing any of my business. I guess I don't have the kind of business they like, but California's lost, especially for personal line stuff, they've lost major carriers, Allstate, Farmers, Nationwide. They're leaving the state, similar to what happened in Florida. I have a large book of property business, and I'm having a heck of a time finding coverage because most of that stuff is frame. Even my buildings that are in perfect shape, carriers don't want. They're using AI to rate a lot of things. They're not actually looking at what the actual property is. So it's becoming a tough marketplace. I mean, I insure a lot of apartments and such, and people think that apartments are owned by big corporations. Most apartments and rental properties, I think the number is like 75%, are owned by individuals, folks that purchase these things to use as rental income in their retirement. And now the retirement has come here, and the premiums for years that were $3,000 are now $15,000. And that's a massive increase, and I'm seeing it over and over again. I mean, I'm almost embarrassed to call my client and say, hey, I worked my butt off for you for 12 hours today, and my best quote is 4 times what you were paying, and that's the only thing out there. I mean, I'll get 15, 20 declinations. Well, I used to be able to get a quote after hitting a couple of markets. It's tough out there.
Okay. Go ahead.
The casualty side, I'm seeing more and more lawsuits on ridiculous things and coverage that Europe doesn't even bother with because they never have these kind of claims, is the employment practices liability. I mean, we have a client that's headquartered in France, and they think coverage in the United States is ridiculous because they never have those kind of suits, where here we see them on a regular basis. The suit, I don't see as many suits. The most suits I'm seeing are in habitational things, and I'm seeing things in employment practices liability, and very rarely a director's and officers lawsuit. But that's what I'm seeing here.
So
No,
I'm
absolutely.
curious.
Sorry,
Do
Maurice.
you mind if I ask this?
Differential just to make here. Generally in London, the business that would come in that we would look at is what we call complex. So it's complex property. So we're not necessarily looking at individual apartments that would come in, because that's not going to provide enough premium income for the insurers. So I think Rick makes a very, very good point to make the differential between the domestic business he's seeing on the more of the residential side, and what we see more on the commercial and industrial side.
Great. Let me go ahead and bring up this question from one of our viewers. With all the carriers leave California, what is so Naz, I'm not really for sure. Solutions for Californians.
I'll answer that one. Hopefully you get a good broker, and most of the business is moving to what's called the excess and surplus lines business. Mm-hmm. The premium in the excess and surplus lines, you might know the numbers off the top of your head, Matt, but I think it's doubled in the last couple of years. It's in the billions of dollars, and it is what it is. California Fair Plan for some stuff, but it's costly and limited coverage, and they're very difficult to deal with. But folks like myself are just out there searching the marketplace to try and find coverage for our clients in California.
Great question there, Naz. Thank you for that. So I have a question for both of you. When it comes to AI, and you're thinking about the impact of shifting the decision making on, if this, how it's going to be rated, and I believe I'm stating this correctly, is that a pro for the insurance industry? Does that make it easier to write business? Or are we going to run into another impact based on the fact of AI making decisions versus humans?
I think it's going to be harder to write business, because Matt goes back to the days where we used to be able to sit and write down all the things we needed on a cocktail napkin and go talk to the underwriter and say, hey, this guy really knows what he's doing. Let's do this and this and this. Or you take in another client, go, you know what, this guy's a real idiot. We better charge him a little more money. But now AI is just looking at a class, and that's where they bring up that question that just came up.
Yeah, that was a good question, Naz. Why doesn't government offer a solution?
The insurance commissioner right now is trying to pass legislation to help out some of these things. I don't want to go too far into this, because then I get all riled up. But the government is what caused the problem in the first place, by thinking they could force insurers to do certain things that became unprofitable for them. That's why we have carriers leaving the state. Because there's a thing, Matt talked earlier about reinsurance. In the state of California, the insurers are not allowed to charge the cost of the reinsurance in their policies. That's like you being a CPA saying, oh, I'm going to charge my client $50 for this hour, but I can't charge him all my costs that would really be in my overhead. So, now that's come home to roost, and now they're changing that legislation. If they can line some of these things up, they're looking to expand the California Fair Plan and pass legislation. I don't know the numbers again, that if you're an insurer in the state of California and you've got so many policies in the state, you have to take X amount of policies in the high risk areas to spread that stuff around and find carriers. It's emergency legislation, and you know how quickly government moves. I've been watching this since the end of last year, and it's slowly starting to move forward.
Gotcha. All right, let's bring up this. I've been curious about this. So buyer considerations as far as property casualty and also other lines. What does that mean? What does that mean for us here, Matt? Let's start with you.
On the property, I think it's about ensuring that the valuations are fair and accurate, and that there has to be a year-on-year increase, not just for the rebuilding, which is natural, but also to take into account the fluctuations with inflation. We've certainly moved beyond peak inflation, or that's the way it appears to be. but nonetheless, ensuring the buyer has the correct amount is very important. If you're a commercial insurer, this was something we touched upon in our previous broadcast. If you are an operation and you do source your goods from overseas, do ensure that your territorial scope includes customers and suppliers which are based outside of the United States. Because if it's not, and there is a problem at the manufacturing or the distribution for the at the place of the customers or the supplier's location, there will be no cover under your all risk policy. So it's very important to do that. We would also say with a number of these things, with deductibles, you can get breaks by increasing deductibles. You can get pricing breaks and also capacity breaks by doing this. We've restructured a number of programs this year by looking at people's retentions and increasing what if you do have a sum insured on a building, say it's a hotel of say $50 million sum insured and it's in a high cat zone, increasing the deductible from 25 to 50,000 can telegraph a very, very positive message to insurers. And we have found that just moving the dial a little bit like this, it's about establishing a trading relationship with your insurer and doing things which provides a mutually beneficial result. On casualty, I'll let Rick talk about that because of the local legislation. But all I can say in London is that US primary casualty is very difficult, if not impossible, to get on an open market basis. The XOL we can look into, certainly. What insurers like in our market is longevity, and it is building a relationship to understand the client when it comes down to casualty. And that is something which is very much very much treasured by insurers, and it's something which does provide long-term views. So if people are interested in the London market, we would certainly say look beyond year one and look what you want to achieve in year 4 or year 5 of your relationship with an insurer. On D&O and on cyber, I would say certainly shop around at the moment. With cyber, there's a lot of very different products out there, and there are some absolutely superb and excellent products out there, but it's understanding exactly what is required and what is needed, and getting the right relationship with your cyber carrier.
I've got a couple on the cyber policies. I see a lot of carriers coming out and moving around in the marketplace. You have to have someone that knows what they're doing, because certain clauses in the cyber policies are going to damage your coverage. You have to compare and make sure you have the right coverage. And then earlier you were talking about the services. Some carriers are calling that now active insurance, where they actually have scanning going on a regular basis to make sure that people don't have holes in their networks. And then on the property side, the replacement cost evaluation, that's interesting and also an issue. I use a couple of different programs for my replacement cost calculators, and some carriers haven't updated their systems. For example, in the Bay Area, Northern California, you can figure it's going to be 300 to 350 a square foot ballpark. San Francisco is almost $600 a square foot for replacement costs. I send these things into the insurance company and they say, no, that value's too high. I said, no, update your system. That's what it costs. I'd look at the construction costs. So I fight with them to get the increased limits. Otherwise, I'm going to have, they're only going to give me $2 million worth of coverage on a $6 million. My client may be happy because his premium is lower, but I'm going to have a big lawsuit when that thing burns down and I don't have any coverage. As far as the legal things, I review a lot of contracts for the insurance and the wording. You have to be very careful what you sign in a contract now. The lawyers have learned how they can, their job is to push all the risks back on the vendor that they're working with. So they don't put, they put clauses not where you'd expect them to be. You expect the indemnification clauses and insurance clauses all to be in the same place, but you'll be looking in the contract and all of a sudden it says, hey, you're responsible for everything that happens on this site. you got to fight to get those things out. I had a big fight with a chemical manufacturer when I was in the construction business. He said, you got to, I said, I'm not signing that. If there's a problem, I'm dragged into the lawsuit. So he said, so they try to throw their weight around. They say, don't you want the contract? I go, yes, I want the contract, but I'm not signing this because I don't want to be out of business. Eventually, I didn't take the contract. Contract went to somebody else. There was an explosion. That guy got dragged into the lawsuit, spent a lot of money just to get out of the lawsuit. But, my job as a broker is to protect my client, to find the best coverage. And as much as I hate to do it, I spend a lot of time arguing with attorneys, but it is what it is. But California has more attorneys per capita than anywhere in the country. So we've got a marketplace that's difficult. Fortunately, we have a lot of good CPAs.
Yeah. To me, Rick, what you're telling me is that, and telling us ultimately, is that one of the trends is that we're seeing the language being adjusted as far as how insurers are going about writing their policies. So it seems like that's another area of concern, which may previously in the past, I don't know, maybe have you seen that type of policy writing or approach to it, or is this something that's different as far as the language is concerned?
Well, if you're working with what's called an admitted carrier per se in California, you have most of the proper coverages and not a whole lot of exclusions. If you're working with the excess and surplus lines, because they manuscript their policies, they can put in or out whatever they want. So you have to, if I ask for this coverage and this coverage and this coverage, I've got to review the quote and make sure it's in there. That's my job. We got another question up there.
Yep. Let's go ahead and bring this up from NAS. Thank you again. How is the market for a COC and RAP policy?
The COCs and builders risk policies, the marketplace, especially with Zurich, they seem to be writing a lot of stuff. I don't have a ton of RAP policies in my thing, but if the COC market is good, the RAP policies will also be good because it's similar coverage. It's just picking up more contractors in the policy. And those are actually becoming more valuable to contractors because then they're sure every contractor that's sitting on their job site, there's the proper coverage and they're not going to have cross lawsuits and everything else going on. Good questions, Nas.
Yeah, very good question.
That is a good question. I would just also add that in the secondary market, we have found that there is a bit more capacity for the builders risk programs in the US over the last year than we'd had in the sort of previous 2 or 3 years.
And that might be due to all the new people paying a lot more attention to safety on the larger policies. I mean, we've got programs that we run with clients, safety programs. In fact, it actually goes to their employee's cell phone. They got to answer the questions. They got to take it. So we're assured that everyone is getting the proper safety training. Proper safety training, proper techniques for building stuff, eliminate the problems. And the contractors, want the problems eliminated because they want to get the building done and they want to get paid. They don't want lawsuits after the whole thing's done. Nas, what's your client base? You ask a lot of interesting questions.
Nas, if you can answer that in a second here. And as he answers that, I want to go ahead and ask a question to the both of you, because I know these have been recent events. The Baltimore Bridge collapse, that was a couple of months ago. And just recently, I think that was as of a couple of days ago, Galveston, Texas, we had another bridge issue there. I haven't read up on it, but if you guys can address those and what the cause and effect when it comes to insurance is on that, that'd be great.
I'll just give a quick overview on what I know about collapses and such. There was a huge study done of infrastructure all over the United States, what bridges are defective, what freeways are defective, and now they're trying to get in there and get that stuff fixed. But if it's a bridge in a local community, they don't have the capacity, the capital to do that. So they're trying to put programs in place to get this stuff updated so things like that bridge collapse don't happen. Fortunately, I wasn't insuring anybody there. It was no loss of lives to anyone that I know, but it's still a horrible, horrible event. Matt, I'll throw this over to you.
Yeah, of course. I mean, this is an event that has really shook through the market and the market that we work in here in London. And so on March 27th, the container ship Dali, which is registered in Singapore, set off from the Baltimore Marine Terminal, and an hour into its journey, it diverted from its straight course and slowed down. And then suddenly all of the lights went out on the exterior of the ship and smoke was emanated from its funnel. It did send a mayday signal when approaching the bridge, and that was great because it did give the authorities some time to stop cars and vehicles from entering the bridge. But it did strike the bridge, and at 28 minutes past 1 in the morning, the bridge started collapsing. And this is what's incredible. At 1 minute later, at 29 minutes past 1, most of the bridge was underwater. So the collapse was pretty much instantaneous.
Right.
There were 6 fatalities as a result of this, which were construction workers who were fixing potholes on the bridge. And what has happened is now that effectively Baltimore Terminal has been out of action, and there's a huge recovery exercise that's being undertaken in order to remove the debris, rebuild the bridge, and get business flowing. Now, with regards to Baltimore Port is one of the largest vehicle shipment hubs in the United States of America because it goes out into the Chesapeake River and into one of the largest estuaries in the United States. So it's a major flow through. 1.3 million tons of cargo passes through the Baltimore terminal every year. So we think about this from a supply chain perspective. This is going to affect a lot of businesses around the country and outside as well, because these finished goods will come in from Mexico, from Canada, from other parts of the United States and go through the port of Baltimore. The insured loss is estimated to be somewhere between $3 and $4 billion, and that will be paid by a number of different sources. So the owner of the Dali, they will be liable for a certain amount. What they've done is they filed in the United States an order stating that they will be liable for no more than around about $50 million. Whether that happens or not is another matter. There could be a negligence issue.
In fact, I do have a client that was affected by that. I have a client that manufactures battery backup panels for solar panels, and they're in Hawaii. I don't know how they can afford to manufacture them there and sell them here, but they do. But they normally ship the battery packs over on ship. Ships can't go. They had a time constraint. There would be a violation of contract if they didn't get the product to the client, so they had to put those on an airplane. You know how much it costs to transport batteries on an airplane versus a ship? So we've got suits there, one for the loss of the products that they had and for the extended cost to ship those things via airplane versus via ship.
Exactly. And Rick, you're right. I think the cost of this could be absolutely devastating to a number of these businesses in order to navigate this, because these costs won't be insured. But
income.
Hopefully they will. But this is where this crosses over, because this is technically a port blockage issue. This is kind of a marine loss. So this is one of these events which straddles different markets. So if you're in your all risk property policy, you would need to have a specific port blockage clause in order to trigger some of these business interruption losses from inbound or outbound marine transit. It's not to say that does or that doesn't happen. Markets will give it, but that does come with a cost implication. The losses will be paid by P&I clubs, which is the marine insurers, and then generally by the global Res, who will be writing in excess of that. And I would imagine that Washington and the taxpayer will also be contributing as well towards the rebuild in one way, shape, or form.
That's right. Okay.
Now I need to get your information, because I think my folks might be able to help you out with some of those things that you're looking at. Sorry about that, guys. I had to get in my advertisement.
I have a quick question. Gentlemen, I know insurance usually has to come. Insurance is set up, but it always, so some of these events, nobody really plans for a bridge to be collapsed. Let's be clear. So insurance is typically coming behind events that are happening. So in cases like this, do insurance, now that this event has taken place, is this now a new alert for insurance companies? Is that how it works? Do they start creating policies and procedures based on this, just in case it happens in the future now that it's happened?
Well, they already have clauses, in fact, like the port blockage clause that would pick up some of these things. And underwriters kind of look at underwriters look for the worst case scenario in any policy that they write. So they think of things like this. They're sitting around the bar going, hey, what if this happens? What are we going to do? So these things are all things, but they're inserted in the policy via clause or endorsement. They're not the normal thing. That's why you have to have somebody that, if you're doing a lot of shipping, you work with a broker that does a lot of shipping. I work with a guy that insures nothing but tow trucks because they have some special oddities. But you have to know the marketplace or have someone you can talk with to help you put that policy in place. I'm fortunate. I've been doing this stuff I'm 73. I've been doing it for over 40 years. I've got a lot of contacts in every single industry. If I don't know it, I'm going to find somebody. Like, as Matt knows, I've written everything from a farm to almost insuring a space station and everything in between. So if I haven't insured it, the policy hasn't been written.
That's fair. We have a response from Naz. Let's go and make sure that we honor him. So I've been in condo and residential development, tried to advocate for a RAP policy and share with the subcontractors. Self-insured retention, the same thing as a deductible. Got it.
But that's excellent to be doing. That's the way to protect the contractor, the complex, everything. You must have a lot of experience in this area because most folks don't think of those things.
Awesome. So I'm curious, fellas, we covered a lot of trends, a lot of things that are happening. What is the forward movement? What is the forward thought that we need to go into? We're midway into 2024. How do we look at this and going into 2025 going forward? What is the new thought process? And I'll start with you, Matt.
I think the last thing that I'll just mention is that everything in the US market and in the global market gets judged by the hurricane season. And this year it has been predicted to be more volatile and more intense than it has been in previous years. And there's a number of reasons for that. And one is because El Nino is flipping into La Nina, which means that temperatures in the Pacific are going to be, the water temperatures are going to be warmer. Now, if we have a disruptive hurricane season, and one where landfalls are made, say there's 20 events and then we have 4 or 5 landfalls, that is going to change everything for later this year and going into 2025. So our thoughts at the moment, or certainly here in London, are shop around, is have a look what's out there, and let's try and be creative in fixing solutions where there are problems, as we've touched upon with the habitational.
Fantastic. Rick, what do you have for us?
It's just like every year when there's things going on, the marketplace is volatile based on the weather, fires, whatever. You have to work with someone that pays attention to all those things, has relationship with some insurance carriers. And I said earlier that they have to know what the heck they're doing. They have to have relationships. The business now is much more difficult than it was when I first got into it. There's more nuances. The carriers are being more picky. You have to read coverages. It's marketplace is the marketplace. I'm working harder now than I ever have before to get the same coverages, but that's what folks pay me for. So I'll keep doing it. I'll keep paying attention. I'm watching the legislation. I'm watching the carriers, and I talk with folks like Matt, and I have fun doing this television show to get the information out to others.
I will say that as well, and I'll echo just what Rick said. I'm 50 this year. I've never worked harder than I've been doing at the moment. just in order to literally to preserve clients' positions, but also to hopefully improve what they've got. And I'm very aligned with what Rick said. And yeah, it's you need people who understand what they're doing.
Amazing. As always, on behalf of Executive Talk, I want to thank the both of you for taking the time to deliver this type of intel to us. As the market shifts like this, it creates, and Matt, you said this word earlier, which is instability. People are nervous about everything that's coming up and losing coverages left and right. And to be able to take the time to offer and explain the marketplace presents that stability. And I want to thank you guys on behalf of all business owners and those that are in the insurance market. Thank you so much for what you do and the amount of detail that the two of you exude. So I appreciate that. So we will make sure that we have you back on later, and we'll keep the conversation because there's more lines to discuss and more changes happening. All right, gentlemen. All right. Have a good day.
You too.
All right.
Goodbye.
And for all the viewers, I want to thank you so much for taking your time to watch Executive Talk and listen to this conversation. As Rick and also Matt would say, insurance is not the most amazing thing to talk about. It's actually what they call boring. But boring is also has implications. It's the most detailed information that you need to have within the business model that you have. If you want to insure your creation, you have to have insurance. And ultimately, you have to know where the changes are. So we're going to sacrifice the boring part and just make this important. Make sure that you understand that this is the service that needs to be provided with you is the details. This is what Matt and this is what Rick do, is they specialize in the details to make sure that you have the proper coverage and the right pricing based on that coverage to keep you going. And that's what we want to make sure that we have the right people on here at Executive Talk to make sure that you're explaining it's about being correct, about being right in this marketplace. It's not about being cheap. Cheap will still have you lose. So make sure we leave this conversation with this information. Please make sure that you connect with Matt and also Rick via LinkedIn and set up a meeting with them, Zoom, Teams, or whatnot, and make sure that you're properly insured so that way you can run your business. But I want to thank everybody for taking the time out of your schedule. But the three of us, we actually have to get back to work. So we'll see you next time. Bye-bye.